All right, let's dive right in. We're going to talk about one of the most fundamental shifts in sustainable investing, and that's the complete transformation of fiduciary duty. I mean, what used to be a massive wall, basically preventing anyone from considering ESG factors, has now become the very mandate that requires it. It's a huge reversal.
So let's start with the classic definition, the way things used to be. For decades, fiduciary duty was incredibly simple. If you were a fiduciary, say a pension fund trustee, you had one job and one job only: maximize financial returns for your beneficiaries, period. Anything else was just noise. And this way of thinking created what people in the industry literally called the fiduciary wall. The logic was pretty straightforward, right? ESG factors were seen as non-financial, fluffy, values-based stuff. So if you brought them into your investment decision-making, you were seen as pushing a personal agenda, and that was a potential breach of your duty. It put you at serious legal risk.
But, of course, that wall didn't stand forever. In fact, it was systematically taken down, brick by brick. So how did this happen? How did this massive barrier just get redefined? Well, it was a series of pivotal legal and regulatory shifts, really driven by a dawning realization that systemic risks, like climate change, weren't non-financial at all. They were becoming undeniably financial. This timeline really charts the whole revolution. Before 2005, the consensus was clear: keep ESG out of it. But then, boom, the game-changing 2005 Freshfields report drops, and it turns the entire concept on its head. It basically argued that ESG factors are financial, and that idea just gained momentum, reinforced by reports like the UK Law Commission's in 2014, until by 2019, you have major regulations basically cementing this new reality into law. And this quote right here, this is the heart of it. This is the argument that changed everything. It completely reframed the debate. It said, look, things like climate risk or labor practices in your supply chain, these aren't some separate, non-financial category. They are financially material risks and opportunities. So ignoring them wasn't prudent. It was actually a potential failure of your fiduciary duty. So you can see how we've moved from this incredibly narrow focus on just financial return to a much, much broader understanding of what best interests even means. The modern view of fiduciary duty is holistic. It's not just about integrating factors into a spreadsheet. It's about being an active owner, thinking about system-level stability, and being transparent. This is a profound shift toward actually protecting long-term value. Now, of course, this evolution hasn't happened at the same speed everywhere. In the US, for instance, things have been a bit more cautious, often treating ESG as a kind of tiebreaker if all the financial metrics are equal. But you look over at the UK and the EU, and they've been way more proactive, with regulators explicitly requiring ESG integration and stewardship. They've really pushed mandatory integration and disclosure. So this radical redefinition of fiduciary duty, it solved one massive problem, right? It dragged ESG into the mainstream. But in doing so, it uncovered a much deeper, far more complex structural challenge that was kind of hiding right there in the heart of our modern investment system. And this new challenge, it's rooted in a really classic conflict, one that's been around for almost a century now: the separation of ownership from control. You probably know it better as the agency problem. Yeah, so the agency problem, first identified way back in the 1930s, is pretty simple at its core. The people running a public company, the executives, the agents, aren't the same people who own it, the shareholders or principals. And this creates this potential for their priorities to diverge. Management might be chasing short-term bonuses while the owners are trying to build long-term value. But today's financial system is way more complex than that. That original agency problem hasn't gone away. Instead, it's been duplicated, it's been magnified, and it's created what some have called the double agency dilemma. This is where it gets really interesting. The late, great John Bogle of Vanguard, he just captured this perfectly. He called our modern system a double agency society. See, it's not just owners versus managers anymore. Now the so-called owners are often agents themselves, investment managers who are managing money on behalf of other agents, like pension funds. It's agents all the way down. I mean, just look at this chain. At the very top, you have the ultimate owners, the person with a pension, the retail investor. But their capital gets delegated down this long chain of agents. First to an asset owner like a pension fund, then to an asset manager who finally deals with corporate management. At every single link in that chain, there's a risk that the original owner's interests get a little bit lost, a little bit diluted. So, Faced with this kind of multi-layered dilemma, how does the system even try to make sure that the person at the top of that chain, the ultimate beneficiary, is actually being served? How do we bridge all these gaps? Well, the answer really boils down to enforcing two fundamental principles all the way through that investment chain: accountability and alignment. And these aren't just buzzwords. They are the actual mechanisms designed to fight that double agency risk and make sure fiduciaries are truly acting in the long-term interests of their clients. Accountability is where the rubber hits the road. It means taking very specific actions, and they're tailored for each asset class. For public stocks, it's all about engagement and using your proxy vote. For bonds, it's about assessing credit risk and talking to issuers. And in private markets like private equity, you have a lot more influence, so it's about using your board seats and direct governance control. And then there's alignment. This is achieved through the investment mandate, that critical contract between an asset owner and their manager. A really well-designed mandate goes way beyond just financial benchmarks. It clearly lays out the ESG philosophy, it sets clear expectations for stewardship, and it creates a tough monitoring process that demands real transparency on ESG outcomes. So these are the practical tools of the trade, right? Stewardship is the big idea, being a responsible guardian, but you execute that through direct engagement, through proxy voting, and you codify it all in the investment mandate. And then finally, robust reporting is what closes the loop. It gives you the data you need to hold everyone in that long chain accountable. Which leaves us with this final question. As fiduciary duty has evolved from this simple wall into this really complex, multi-layered mandate, it forces us to ask, where does the buck really stop? In a system of agents representing other agents, who is the final guardian of our collective, long-term economic and environmental future? Honestly, the answer is still being written. Thanks for joining this explainer.